So, hi, good morning, and welcome to today's roundtable discussion with DEMIRE AG. I'm very happy to have Tim Brückner, the CFO of DEMIRE, at my side today. Tim will guide us through the developments DEMIRE has made in the recent years, especially focusing on the refinancing, which was just finalized formally this week. However, I think the main focus will be on the operating development following the success going forward and the path in the coming 2 to 4 years. So with no further ado, I would hand over the word to you, Tim. Please share your presentation and go ahead.
Thank you. Welcome, everyone. Thank you for the brief introduction, Philip. We have obviously prepared some slides. I will not read out all the slides, and I'm most welcoming all questions that you may have. Okay, so are we in the presentation? Then I start. So apologies then, everyone. Zoom collapsed. It's probably a sign that the German real estate market, and not only the real estate market, is in big trouble. Nevertheless, I think DEMIRE got out of the worst over the last few weeks, and I'm here to tell you something about it. I believe most of you know DEMIRE. DEMIRE is a listed real estate firm focusing on commercial real estate markets in Germany. We have properties across Germany in so-called secondary locations. The portfolio, after some revaluations over the last 24 months and some disposals, is roughly 1 billion, consisting of 54 assets. We have a 64% office overweight, about 30% is in retail, and the remainder is in a handful of hotels. We have a contractual rent of about 58 million on an annualized basis. That represents on our current valuation a 7.1% gross yield, demonstrating that the valuation of the portfolio is not super high. Unfortunately, over the last 18 months, our vacancy rate increased. Luckily, in 2024, we have increased our letting ability and increase the space we let to existing and new tenants, so that I expect that vacancy is going down over the next few months. We have a weighted average lease term of roughly 4.4 years, which I think for an office portfolio is relatively high, as you have to imagine that usually new office contracts are signed with a 5-year duration. We try to be as transparent as possible. We achieved the usual EPRA ratings for the best practice recommendations on the financial side and also on the ESG side. And obviously, we prepare ourselves also for an extensive CSRD reporting for the next financial year, 2025. Good. So over the last 18 months, we kind of worked on the extension of our corporate bond that we issued in 2019, and that would have matured in mid-October this year. As you have seen from our press releases within this week, we have now reached the effective date on the Börse Luxembourg. You can again trade our bond. And we received an updated rating from Moody's. Given the structuring of the bond, the structure of the shareholder loan we received by Apollo, unfortunately, the rating did not considerably increase, but you should expect a rating from a second agency, hopefully and most likely a bit better before year end. The restructuring of the bond really helped us to stabilize the business. As you might have seen, the new maturity is end of 2027. The coupon of the bond is 5%. And there are some potential further add-on payments if we don't sell assets and repay the bond over the next year and the following year, and do not fully repay the bond until year end 2026. So not only the equity of DEMIRE might be of attraction, also the bond. What is now important for the company is obviously to look forward and stabilize the business. We have to work on our real estate portfolio. As said in the most recent calls, we are potentially still a seller of real estate in 2025 and also in 2026. As you can see from the terms and conditions of the bond, There are some disposal targets. There are no obligations, but some targets, and we are aiming to fulfill those targets. The targets are to sell a net of 50 million in 2025 and a further 50 million in 2026. This would obviously shrink the portfolio and have a negative effect on the contractual rent and eventually earnings. But nevertheless, it would help to further deleverage the company and make full refinancing available. Obviously, the company aims for full refinancing as soon as possible, not only the corporate bond with a remainder of roughly 250 million, but also the shareholder loan that we have received from Apollo with 100 million, which has a PIK interest and is maturing after the bond maturity in 2028. But as said, we want to obviously repay that as well as soon as possible to limit the interest expense and increase the earnings of the company. On an operational side, we have strengthened the asset management team. As you know, we have a new CEO. Frank Nickel is very experienced in the real estate market. His previous roles were with the banks as a CEO of CA Immo, and he was also the CEO of a large broker. So he has really in-depth understanding of real estate and asset management. We have hired a new head of asset management, and we will increase the team to make sure that we move down with our relatively high vacancy rate. And the target that we have communicated also in the past has not changed. We always aim to keep the vacancy below 10%. And I absolutely know that will be a difficult task in challenging times. What the real estate market sees is a negative GDP evolution in Germany. We see a potential trade war coming. That trade war will have a negative or might have a negative impact on GDP. But at least from the last 6 months, we saw an increasing letting activity in our portfolio. So I'm pretty confident that with more efforts on our portfolio, we will be able to increase cash flow and lower the vacancy of the portfolio. Looking forward, within the next 24 months, as said, we are probably a net seller of real estate, but I think there is a future for a company like DEMIRE. There is a future for secondary offices and secondary commercial real estate. And as soon as the market will pick up more, the transaction activity will increase. I'm sure we will also be able to benefit from opportunities in the market. Unfortunately, we failed on sharing the presentation. So before I'm talking more and not answering your question, I would very much welcome you to raise questions and give me the opportunity to answer what you're really interested in.
Thank you very much, Tim. What I forgot to say in the beginning, there is 2 ways for you to ask your questions. First opportunity is that you can ask questions via the audio line. For this, I would kindly ask you to raise your hand. Afterwards, I would unmute you so that you can ask your questions. The other way is our Q&A window here. You can send us your questions in written form. I will read them out and Tim will answer them afterwards. As I currently see no hands up, but we have the first question in the Q&A session. I would think we start with this. The first question is, you answered that partly before, I think, but nevertheless, what is your general view on the German office market? Do you expect recovery to kick in the coming year, or do you expect a further deterioration of the situation?
Well, we probably have to differentiate between different segments in the office market, and we have to differentiate between the transaction market and the letting market. I think what we have seen in the transaction market that from the start of the Russian invasion in Ukraine and the deterioration of global economies, rising prices and so on, there's been a huge price gap in expectations between sellers and buyers. And what we see is that this gap is closing. I think we are close to year end now. Usually Q4 has the highest transaction activity. We would expect that versus last year, there is a higher transaction volume. And when we speak to valuers or to brokers, they usually also expect or see in the market that the price gap and the expectations between buyers and sellers are narrowing, such that I would think it's most likely that we see more transaction activity next year, which is also fueled by lower interest rates. Obviously, we don't only need lower interest rates, we need banks being able to do new business, but at least the environment in the first instance looks relatively positive for the transaction market. What might hinder this positive evolution is what I tried to say before. We are maybe seeing a trade war coming. We may see rising tariffs. We might see a very negative impact on the German economy, maybe only on various segments. But as we all can imagine, if the car industry suffers big time, it's not just the car industry, it's basically, it would have a very negative impact on GDP. And what was always visible in the past, that if there's a negative GDP evolution, the letting activity collapses. Currently, and our portfolio is probably not big enough to have statistical evidence, but we see government be relatively active as a tenant. They are shifting space and they are not really reducing space, which is good for us as a landlord, maybe not good for us as individual taxpayers. On the private side, I think businesses are really careful when committing into, let's say, long 5 or 10-year lease contracts, because they don't have clarity on their business plans and they are relatively negative on their outlook. So my general perception of the letting market next year, it certainly requires some stability, and we probably need a new government, and we might also see some easing in ESG requirements, which I'm not personally a fan of, but we might still see it, and it would certainly help the real estate market.
Thank you. I think that answers very well answers the question. The next one is a follow-up. You just said that you will be a net seller of real estate in the next 24 months, and that implies that you will also be a buyer to some extent. Where do you focus if you buy real estate? Do you have any special targets there?
No, well, if you look at the terms and conditions of the restructured bond, there is the theoretical possibility to buy, and obviously with Apollo and Becken in the back, and Apollo has committed 100 million into the structure. I think that despite the interest attached to it, you should see that that is a strong commitment. There might be the opportunity to buy. I mean, if we are a buyer, I would think it would be strictly according in the ABBA strategy. Let's say we would buy reasonable size, good buildings in German secondary cities. It is not super likely that we are a buyer. If our disposal program is very successful, it is more likely that we are a buyer as well. If we struggle to sell 50 million next year, we will not be a buyer. So it's too easy, and it's not easy to answer, and we should probably come back to that question, let's say mid next year, when we have more clarity on the success of our disposal program.
Understood. Maybe a question from my side. In your recent earnings call, you and your fellow management told that you were confident to dispose of up to 50 million until year end 25. So you are confident that you can avoid the penalty fees in 25 and 26?
From today's perspective, we are absolutely confident that we are able to avoid those. But you have to have in mind that the penalty fees are not low, but they are also not super high. If we only have the opportunity to sell properties at heavily discounted prices, it makes more sense to pay the penalty instead of selling the real estate. So we will obviously really carefully look at it. But from today's perspective, I'm confident that we sell more than 50 million in 2025, and again, more than 50 million in 2026.
Understood. Maybe one further follow-up from my side on that. What would be your red line on? You just mentioned it on discount. Did you have something like this?
So there is obviously discussions within the management team and also the supervisory board, but there is no specific red line. It very much depends on the specific situation. But you can easily do the math yourself. If we pay 3% penalty on the remaining outstanding bond, that's like 7.5 million. That's about the discount we can take. If the discount is significantly higher, it just makes no sense.
That makes perfectly sense. Thank you. The next one is on your LTV. You just mentioned that you want to reduce your LTV to below 50%. What is your general LTV target for the midterm?
Well, we always try to keep the LTV at around 50% level. I think DEMIRE will not be a company with an LTV of 30%. It does not make sense also in terms of the shareholder base and the structure of the portfolio, but to make the company refinanceable in every market condition, I guess the LTV needs to be lower than 50%, and I hope that we are getting there.
Perfect, thank you. The next one is on the Limes portfolio. How does the insolvency of the portfolio affect your operations? And follow up on this, could this have been avoided, or was the insolvency the right step in your opinion?
I'm sure that the financing bank has a completely different view than I have on this. I mean, there has been a lot of press about this and coverage. We were making progress with the banks, and we had a term sheet from the bank at the time, but we were just not able to sign it because when we had the restructuring agreed with the note holders, it became clear that the available cash at DEMIRE cannot be given to the Limes portfolio. It has to be given to note holders. And I guess what the bank did not really understand, or did not want to understand, that if we would have given the money to the bank or to the Limes portfolio, the entire structure would have been insolvent. So for the management team, it was pretty easy to decide we need to save the business and not save the portfolio. Did we like it? Certainly not. Did we want to screw the bank? No, we did not want to do that. We wanted to find a solution. And as you could read in our releases early June, there was a solution in place that Apollo takes over the Limes portfolio and provides funding such that the bank would have been able to extend it. And DEMIRE in this structure would have been the asset manager and the development partner for the portfolio. Unfortunately, the bank did not agree to this. And the management of the SPVs, basically myself, we had no other opportunity as to file for insolvency for legal reasons because we were not able to find an agreement with the bank. Was that good? No, it was not good. It was not good for the company. It was not good for the bank, I believe. The current status is that we expect the opening of the insolvency proceedings shortly, and it is most likely that DEMIRE will stay involved as asset manager and transaction manager of the portfolio. And as we said in the latest call, we are pretty confident that we get out some cash from this insolvent structure after the repayment of the loan of the bank.
Thank you. I think that that covers it perfectly. We have one last question in the queue here, and this is regarding the shareholder loan, which you also mentioned before. Is there a possibility that this will be swapped into equity in the end, or will it be paid back fully?
Well, my crystal ball remains a bit unclear. Well, structurally, it is a shareholder loan that should be repaid at maturity or before maturity. In all honesty, we will see after the repayment of the bond, how are the financing markets? Is there an opportunity to refinance the business in the debt capital markets, or can we refinance the company on the mortgage market? If it's possible, we will just repay the shareholder loan. If it's not possible, we would have to discuss conversion into equity. But at this stage, this remains a loan, and the company has a business plan assuming to repay it in full.
Perfect. Then I will have some closing remarks. We had some technical issues today. I have to apologize for that. I still think that it was a very informative call. And also from my point of view, what I have not mentioned before, I have currently a buy rating on DEMIRE with a price target of €1.50, which is based on an NAV calculation. In my point of view, the stock is currently undervalued compared to other real estate stocks in the market. So to the participants, also please feel free to have a look on the research on our website. And with this, I have to thank Tim. I have to thank you for your participation, and wish you a nice rest of the week, and see you next time. Have a good day.
Thank you very much.